Hello there, welcome to a very colourful video today. We're talking about ETFs, exchange traded funds. I recommend these very often and I own some myself, and I think it's the best way for people to get started investing in the stock market. Now I'm going to be giving you some facts, some numbers, but also my personal opinion sprinkled on top. So as the name implies, exchange traded funds are regular stock funds traded on exchanges. So you can buy and sell them freely at any point, at any time, instantly, just like regular stocks. So where traditional mutual funds require you to sign up with the provider providing the mutual fund, ETFs are all competing freely. You just need a broker account. Now, just like with regular stock funds, ETFs are basically baskets of stocks. So it's many stocks. It could be tens, hundreds, or even thousands of stocks in one. And you get the average of all of those stocks of companies. And ETFs usually makes up indexes, such as a technology index, an industrial index, a defense and aerospace index, US, Europe, China, low risk, high risk, mid cap, small cap, large cap, S&P 500, you name it, there's an ETF for it. So whatever part of the economy you really want to invest in and you're very optimistic about, you can find an ETF targeting that exact part of the economy. So the great thing about ETFs is they'll let you target a specific kind of stocks, but they're still very safe and they automatically give you great diversification. So it is a very safe way of investing in stocks. Also, almost every single ETF pays a dividend. So that's interest on the money you have invested, just like regular mutual funds. Now, ETFs are also passively managed, which means there's no manager picking out stocks that are in the ETF. They simply follow an index. So that's why they're cheaper and more efficient than regular mutual funds. So while the average expense ratio for ETFs, so that's how much you have to pay of your holdings every year to have money in the ETF, is 0.44, while traditional index funds, mutual funds, you have to pay 1.3% on average. So already there, you're gaining a massive edge. And keep in mind, they pay pretty much the same kind of dividend. And while 0.44% is the average expense ratio, most broad ETFs like the S&P 500, for example, or a Vanguard total stock market offers you as low as 0.05% expense ratio, which is miles away from index funds. And much due to the efficient and cheap nature of ETFs, there is now 3.42 trillion US dollars under management globally in ETFs, and there are 1,707 ETFs offered in the US only. And in US listed ETFs, last year in 2017, there was an inflow of $466 billion versus $177 billion in 2016. So you can really see how the inflow, so the money coming in to ETFs, is really picking up steam. Now the largest providers, so these are all great providers, trillion-dollar companies. There are Vanguard with the ticker symbol V in front of the ETF usually. Then you have BlackRock with iShares, so that's usually an I in front of the ETF. Then you have State Street Corporation with SPDR ETFs. They have the SPY, or aka Spider ETF, which is the largest ETF in the world tracking S&P 500. And then you have Invesco with their PowerShares ETF series. So they have for example, the QQQ Nasdaq ETF. So these providers provide broad market ETFs, some more specialized one. They usually stick to US, international, Europe, Asia, or maybe sectors, like technology or consumer staples and so on. Now, one smaller provider I will mention, which is my favorite one. I own 3 ETFs from this one company called Global X. They provide niche, very special, unique ETFs for a lot of new industries and new parts of the economy, booming sectors such as robotics and artificial intelligence, Chinese tech companies, and lithium. So those are the 3 ETFs I own. Now, in terms of some of my personal favorites to get started from ETFs, there is VYM, which is the Vanguard High Dividend Yield ETF. This is, in my opinion, the go-to broad US ETF. Pays like 3% dividend, 2.7 or something. Such a stable stock. It's pretty much the S&P 500 with emphasis on dividend. Then you have the SCHB, which is the Schwab Broad US Market. This is just as good as the Vanguard ETF. I believe this is the cheapest ETF in the world at 0.04 expense ratio. Pretty much nothing. And then you have, of course, you have the SPDR, the SPY from SPDR, which is S&P 500 ETF. You have VGT, which is Vanguard Information Technology, which is basically tech. So it's like all the big tech companies, Microsoft, Google, Apple, Intel, Nvidia, and you name it. That's also a great one. Then you have ITA, which is, I believe, iShares Defense and Aerospace ETF, a very promising sector in my opinion. Then you also have VT, which is the Total Stock Market ETF from Vanguard. This gives you exposure to the whole world, big cap and small cap. You also have VGK, which is Vanguard Europe ETF, VPL, which is Vanguard Pacific. I also like QQQC, which is the Chinese Technology ETF from Global X. And my favorite one will have to be BOTZ, aka BOTS, which is the Robotics and AI ETF from Global X. Now, I get a lot of questions about ETF, what to look for, how can I make money with this ETF? And what I would say is, first, the most important thing is what stocks are in the ETF, right? If you want defense companies, it better be defense companies in there. So check the list of the top 10 companies, make sure you like them. The second thing is expense ratio has to be as low as possible because it really eats into your gain if you have to pay like 0.5% every year. And if you pay a high expense ratio, it's a small niche ETF, like a small sector of the economy. And so if you want an ETF for stuff like that, like robotics and AI or Chinese tech companies, you will have to pay a premium for that. But broad market ETFs should be in the range of 0.05 to 0.3. Anything above that for a broad market ETF is, in my opinion, way too expensive. Now, also look at the dividend. A lot of people want dividend with their ETFs, and I understand that. So those are pretty much the 3 things I would look at. I recommend checking out ETF database, www.etfdb.com, which is my one source for all ETF things. You can also compare ETFs, because if you want, let's say, a high dividend yield ETF, you can make a list of all of the dividend ETFs and then pick the one with the highest dividend and the lowest expense ratio, for example. You can also track things such as dividend growth, how much the companies in the ETF are growing their dividend. There's a bunch of stuff you can do. There's a lot of new ETFs using AI and all sorts of algorithms. There are short leveraged ETF, mineral ETF, bonds ETF, real estate ETFs, you name it, there's an ETF for it. And now I'm tired of saying the word ETF, so let's round this up. I think it's a great way to get invested, way better than traditional mutual funds. So go for it. Any questions, let me know. As always, I'll see you in my next video.